It's said the money makes the world go round, but it can also make your head spin. So, all this week, the fundamentals with economist Craig Alexander, licensed financial advisor Shay Myers, professor and economic policy advisor Brett House, and economist Kaylie Tiessen. Tonight, how debt works. That's next on the agenda in the summer.
I think when it comes to debt, I've always heard there's good debt and there's bad debt, and it always makes me so confused. So this would be a great opportunity for us to dive more into debt. In the break, before we started filming, we were talking about mortgage burning parties, and I want to know what that is, Craig. Like, what was that? That's when people actually didn't have any debt?
Well, if you look back in Canadian history, during the 70s and early 80s, we had exceptionally high inflation, and that pushed up interest rates to incredibly high levels. And so,
how high are we talking?
Well, at one point in the early 80s, you had mortgage rates that were above 20%.
But housing was like $5. I'm joking.
But incomes were lower too.
Yeah, so because mortgage rates were so incredibly high, if you got to a point where you'd actually paid off your mortgage, people would have a mortgage burning party to celebrate the fact that you finally became mortgage free. But your point though is really important when it comes to like why do we have so much household debt? And 3/4 of household debt is actually mortgage debt. So the bulk of it isn't credit cards. The bulk of it is mortgage debt. Mm-hmm. And part of the reason we've ended up with so much mortgage debt is that as interest rates have come steadily lower and lower and lower until just recently, what that did was it actually made it cheaper to borrow. And the Bank of Canada had been very successful prior to the latest inflation shock at keeping inflation low and stable. And this meant that interest rates became relatively stable. And what that meant was that compared to the 1980s, where you could take out a mortgage and 5 years later, you could find out that it had gone up by 5 percentage points, 6 percentage points, or maybe you were very fortunate and they fell 5 or 6 percentage points. We had very high mortgage rates, we had very volatile mortgage rates. So how much debt are you willing to carry? Mm-hmm. And the answer is a lot less than the amount of debt you're willing to take on when interest rates are low and stable. And that contributed meaningfully to the amount of debt that Canadians have accumulated in recent years.
Well, Brett, I wanted to come to you after that because when we talk about household debt, a lot of us are able to get on the market, if we get our toe on the market, with mortgages. So help us understand what is credit? Because in order to get a mortgage, usually you have to have very good credit.
Okay. Well, you can think of the word credit in two different ways.
Okay.
One, which you're leading to, is an assessment of your credit worthiness, the probability that you are going to be able to take on debt and pay it back, and that's what your credit score is meant to reflect. It's not a perfect measurement or predictor, but it's a rough assessment that financial institutions will use to assess how much debt you can take on and what type of debt you can take and how willing they are going to be to lend. More broadly, credit is that whole collection of loans, mortgages, student borrowing that we take on because we think we are going to use that productively to increase our capacity to pay it back over time, and that we are going to use it to generate income that more than pays it back. For instance, when we take a student loan, it's an investment in ourselves, an investment in a degree, because we think that's going to put our income on a permanently higher trajectory. We'll more than pay off the loan, and it'll keep paying dividends later on.
Well, sometimes that doesn't happen, but we'll come back to that.
It doesn't, but that's the
That's
expectation, and that's why we take it out.
Okay, right.
Yeah.
Kaylie, where do these loans come from?
Where do the loans come from? So if you go back to the conversation we had when we were talking about where money comes from, we started talking about pooling our money so that banks can lend it out. And essentially, that's where access to a loan is coming from. If you take it out through a bank, it's because they have pooled the assets, the cash assets of millions of people to then be able to lend it out to others who don't have it in their pockets at that time. You might go to a mortgage broker, you might go to a bank, you might go to a parent or a family friend in order to get that loan, but those are kind of some of the places they come from.
The bank of mom and dad.
Hey, some people are using it more and more if you're lucky enough to have access to it.
Yeah. Is that debt then?
I think it depends how each family structures or makes that agreement. It could be a gift, it could be a loan. Every family will structure it differently. But we are seeing a lot of young people who are buying houses now, going to their parents or grandparents in order to get money for a down payment. And I think that is more often a gift, but I don't know for certain. Maybe one of the rest of you does.
Never lend money to family.
Or always
Inside
lend money to family. Particularly in a time of rising interest rates, that might be a way of really cushioning the people who are closest to you against some of those increased costs and getting them into the market in a way they might not be otherwise. We certainly see in the housing market that's increasingly
It's
the case.
necessary now.
Yeah, because even you could set, as an individual, you could set a much lower interest rate or any kind of agreement that you wanted.
Yeah.
But if you don't have those options, you have to apply for a loan. And as you mentioned, credit score is what's measured, I guess, to see if you're loan worthy. Shay, what's a credit score?
Yep. So taking it a step back, a credit report, essentially I like to think of it as your report card, and then the credit score is a grade. So it assesses or it showcases your financial responsibility, and there's a number range from 300 to I believe it's 900. I think the average for Canadians right now is 761. You can correct me.
That sounds good.
It sounds great.
Yeah.
And essentially it, like Brett said, it shows lenders how responsible you are and the likelihood of you paying back the money that you've borrowed. One thing I've noticed actually with speaking to individuals is that a lot of people don't know what their credit score is, mainly because they're afraid to look, but also because they think that if they check, it has a negative effect on their score. So there is a hard check and there's a soft check. So you can check your score as many times as you want and there's no negative effect on that. But if a lender checks it, it could have a negative effect.
Why? Doesn't it just seem like someone's checking? Why is that looked at badly?
Why is it looked at badly? Actually, I don't know why it's looked at badly.
Do you know?
Well, it's mainly because if it's seen that several financial institutions are pinging in and looking at your metrics, it's an implication that you're shopping around, trying to find the one institution that's going to give you a loan when maybe others haven't. And so that's seen as maybe a sign of desperation. What's also not readily apparent on credit scores is all of the algorithms and calculus that goes into them. For instance, to get a decent credit score, you actually have to start borrowing at some point. And your credit score isn't going to exist until you enter the debt market.
But in order to get credit, you have to have credit already?
I know. So there's a little bit of a catch-22 there, and it's why it's important, and I know Shay's emphasized this in our conversations, stepping in to credit markets in tiny ways. And so, you mentioned how that credit card in university kind of went awry for you, but, with a very tight limit on it, that people can demonstrate their ability to pay back small amounts every month, that starts building that history that pushes up those credit scores.
Why is it important to have a high credit score, Shay?
So lenders are more likely to allow you to borrow money if you have a higher credit score. Again, it's showing that you are able to borrow money and then pay it back on time. Another piece of that is different types of debt. So if you've shown that you can borrow and pay back different types of debt, that's also seen as a good thing. But mainly it's like a grade on a report card, right? So
if you pay on time,
why do we want a good grade, right? Yeah. We want a good grade because it shows that we understand the information and we've passed tests, and that essentially we are, smart,
and
intelligent.
the flip side of it is if you have if you have a poor credit score and you need access to funds, it could mean that you end up taking an option that is far more expensive in terms of borrowing.
Like higher interest rates.
Yeah, like you could get charged a higher interest rate, or you could end up borrowing outside of the outside, say, the banking market, and
Like
you're
the black market, or I don't know what they call
Payday
it.
you
lender
don't have to go
or-
quite that far, but if we just go to payday lenders, for
Right.
example, the interest you're going to be charged is going to be a lot higher, and the individuals that tend to use those sort of services it's often because they don't have access to a cheaper alternative. Right? So there's benefits from having a good score, and there's also detriments to having a poor score.
Yeah, and even taking money out from, say, a payday lender when you have a low credit score and then trying to pay it back, if you can't right away, it builds and builds, and you're in this negative cycle where your score might actually get worse and worse. It's one thing that I've thought about a lot, kind of in passing, is just that folks who maybe are a little bit riskier in terms of what a bank is looking at because their credit score is low, we make it that much harder for them to build their credit score, and just by adding that extra interest, actually make them a riskier bet.
So it's like a Ferris wheel, it just keeps going on. Does something like this exist on a larger scale for countries, Craig?
Well, there is, yeah. There's credit ratings. There's credit rating agencies whose job it is to evaluate the credit worthiness of governments, for example. Right. So in the case of Canada, the government of Canada has a AAA credit rating because its finances are in better shape than its international peers.
AAA is the best.
So AAA is the best, yes. And the credit rating agencies will also rate the bonds, the debt that is issued by businesses. And there's different grades as well. And what that tends to do is it impacts the cost of borrowing. So the lower the credit score that a government or a business has, the higher the interest they're going to have to pay in order to borrow from the market.
And then it gets passed on to us, I guess.
Well, it does. It gets passed on in a couple different ways. You know, if government has to pay a higher interest rate on its debt, that's going to get reflected in the taxes or reduction in services that we see. Or it will also filter through in financial markets to the costs that banks, companies, and individuals have to pay, because the rates that are set in financial markets are typically benchmarked off the government or the sovereign yield or interest rates they pay. So if you're in a country with a very creditworthy government, you're going to typically see lower interest rates all across the economy. If you're in a country, you know, with a government that has defaulted on its debt several times, interest rates across the economy for everyone are going to be higher.
On a national economic level, what's the purpose of having credit or debt for a country?
Lots of reasons. One of the first is you can think about all of the things that government does to build the infrastructure that we need in order for society to function. We can hear sometimes the train going through right now. So thinking about the subway system, and a government doesn't just pay for that in one go. They actually borrow money and pay for it over time. Roads, bridges, potentially even something like childcare, and sometimes healthcare services if government isn't taxing enough to pay for all of the things that we need. And then there's emergencies that come up, like the pandemic, for example, and we saw government borrowing increase dramatically for a really important purpose, which was to not tank the economy. And they were successful. So we have a much higher debt than we did before, but much higher than it was, and done for the purpose of protecting us all from economic collapse and, you know, a long depression.
Craig, you mentioned that we have a AAA credit score. Why do we have such a strong central bank?
If we look at the Bank of Canada, it has an extremely good credit rate, or it has a very extremely strong track record. For the government of Canada, it's really about the history of the government of Canada. So if you went back into the 1990s, we actually had a fiscal crisis in this country, and the Wall Street Journal at one point referred to the Canadian dollar as the peso of the North, as a reflection of the fact that they were worried that the government of Canada actually couldn't pay its bills. And so coming out of that period, what happened was the government found, in a sense, religion around running balanced books. They cut the deficit, they balanced the books, and for a very long period of time, Canada basically was running, and in fact, Canadians in general felt that it was responsible fiscal policy for governments to balance the books. And so we actually had a lot of fiscal discipline prior to the financial crisis of 2008, 2009. Then when that hit, the government had to inject a lot of money to help support the economy. And since then, it's been hard for Canada to balance the books. And because of that, Canada's been running deficits. The debt level has gone up. But when we compare ourselves to other countries,
We're doing okay.
we actually compare quite favorably. Now, I do think the federal government sometimes gets an easy ride on this because they compare themselves to like the government of Canada to say like the government of Germany or the other countries. In Canada, we have two levels. We have the provincial governments as well, and in many other countries, they don't actually have that level of government. And so we really should be looking at federal plus provincial debt in aggregate. But even when you do that, Canada still looks favorably, compared to other countries, and that's why we have a strong international credit rating.
I think at some point in all of our lives, I know I've heard this from the adults in my life, that if you can't afford to buy something, live within your means, don't buy it. But it's important for us to have credit. Yes? So why do we want credit?
Well, there's a distinction to make between the things that you're doing with that credit. If you are investing in something with that credit that is going to increase your income over time, that will increase your earning power over time, that will produce cash flows over time. It's a very different thing from borrowing to spend on consumption, on a holiday, on an experience that is not going to continue to either increase your earning power or produce some kind of income stream.
On a personal level, why is it important for people to have credit?
If they want to, again, borrow money to use for things like maybe a house or even to invest, they're going to have a better chance of doing that if they have decent credit. I would say that's the main thing. Yeah.
What about, is it living outside of your means by having credit?
I think having access to credit, let's say a line of credit that you aren't using, so it's not a loan yet, but is access to money that isn't yours, means that you have a little bit more of a buffer in case of an emergency as well.
Yeah.
All of a sudden you're injured and you can't go to work, or your long-term disability benefits don't kick in and you need to fight that kind of thing. Having a little bit of access to a little bit of credit means that you can weather some of those storms in life a little bit better. And when you have a higher credit score, then you're more likely to be able to access that sort of credit.
But it goes to your point about, like, are you living beyond your means? Well, if you're borrowing, it allows you to spend more than you currently have.
Right.
But the question becomes, what are you spending it on, right? And it's there's direct parallels between government and individuals, right? So for government, as said, governments will borrow because they want to build bridges and roads and infrastructure that the economy needs to grow and expand. You can, from a social point of view, you can be making investments that will have a long-term return on that investment. So it's going to, in the long run, it'll actually make up for the cost that you're paying out today, right? The government's decision to expand investment into early childhood education is a great example, because what it does is, by providing more early learning and childcare, it allows more predominantly women to be engaged in the labor market. That means they'll generate incomes, their household incomes will be higher, and they'll pay taxes on that income. So the government shells out money up front, but it's going to get, over the long run, they're going to get a benefit from it. Same for individuals. If you told, without credit, you would actually have to save the entire value of the house that you want to buy, and you couldn't bite that purchase until you've accumulated all of the money to buy the house. Clearly, there is, a benefit to taking on debt, in order to make a purchase of a home that then you're going to get the stream of services from, you're going to benefit from, you're going to get a certain quality of life from. And, the hope would be over time, the asset will appreciate. And so not only will it will cost you interest to have the mortgage, but, history has been that it's been a great investment in terms of a source of wealth.
So is this what we mean when we talk about good debt and bad debt?
Well, I think so. To go to your original question, is credit a case where you're living beyond your means? Yes, when you're borrowing, you're living beyond your means in the immediate moment. But good debt is when you live beyond your means and you take out credit that is going to increase those means over time.
What about defaulting? Because I did share that I defaulted on credit card, $500. I'm good now. The repercussion was for 7 years, I couldn't get credit. Is it different when you default as a country or when you default as an individual? Can you help us understand that a little bit better?
There are similarities and there are differences. When you go into a credit crisis as an individual, a lot hinges on what the causes of it were and how early you actually talk to your lenders to anticipate those problems and try to work out some compensation for them. Governments get into similar problems, and the big difference between individuals and businesses and governments is that we don't have an international bankruptcy process for countries when they get into financial trouble. And so we have a very messy workout process that has huge negative impacts on societies when their debt suddenly becomes unattractive or unsustainable, or they default on it. That leads to a stop in payments to countries. Often they can't import key goods and services like medicines or technology, and that can stunt human development for several years as they work their way out of that. At the individual level or in businesses, bankruptcy is one of the most effective policy developments we've had in modern societies. The fact that we can draw a line under people's debts, help them reorganize themselves, and get back on a sustainable earning platform is a huge change from the past when, as Craig pointed out earlier, people could default on some aspect of credit and be persona non grata in the financial system for the rest of their life.
I can't even imagine that. You can't make a mistake at all. Kaylie?
Yeah, well, I'm just thinking about these two pieces that you've presented, and wouldn't it be great if we could put a system in place for countries that have had financial challenges? Canada is nowhere near that, just so everybody knows. Like, that's not something Canada is close to, but there are countries around the world that have faced these problems, and the systems that are in place now actually make it so much worse for the government and for all the people that live there.
In fact, we don't really have a system.
Yeah, okay.
There's nothing equivalent to what the U.S. calls Chapter 11 or a bankruptcy process here. So it is a messy, long, drawn-out period of negotiations.
And I'm not worried about Canada, but in the wake of the pandemic and all of the government borrowing that had to happen around the world as governments tried to help their people, when you think about the amount of debt that governments have taken on, and then imposed the interest rate shock that we've just had with a sharp increase in interest rates. And when interest rates go up, for example, in the United States, it tends to push up interest rates around the world, right? I actually think that there's a significant risk that we could hear about governments not being able to make good on the financial commitments that they've made. And this could be an important story as we move forward.
In fact, it really already is. Countries like Egypt are facing substantial financial crises right here. Many countries in Africa and the developing world are in very tight financial constraints, and other emerging markets are likely to be. But I really want to build on Craig's point, because if you look at some of the press, if you look at Twitter on a day-to-day basis, you see people lighting their hair on fire almost every day saying Canada is on the edge of a financial crisis or a public debt crisis. We are nowhere near one. Not only do we look great against our peers, we look great against our history. If you look at the share of public debt service, the principal payments and interest that the Canadian government is paying compared with national income or GDP every year, our capacity to pay those amounts, that ratio's at the lowest point it's been in decades. You remember the late 80s, early 90s, and those big deficits we had and the really tough medicine we took to get those deficits and our total debt stock down. And it's reasonable you don't want to return to that. But the problem now isn't that Canada's on the edge of a financial crisis. The problem is you can critique what governments are spending on. You can, ask tough questions about are they doing the right things to increase our means or our productivity or growth over time. But saying we're on the edge of, a debt crisis is completely out to lunch against the data we have.
And imagine too, like if you are a person and you default, you mentioned that bankruptcy can be a fresh start for individuals, but it probably to make that decision, you have to be in dire straits. How does defaulting impact people on an individual basis, Shay?
Something that's really popular is debt accounts going into collections, and people don't really know how to sort of navigate that. So typically, if you miss a payment, I believe it's 90 days, your debt account will get sent to collections, which is a negative effect on your credit report. And there's a bit of gray area, and I'm going to pull from my experience of being a debt collector, but there's a bit of a gray area of like what happens when your account gets essentially sold to collections. People think like, I'll just forget about this debt account, but it does negatively affect your score and your report. So it's important that you are making that payment and also going the extra mile by requesting that it gets removed from your report so that it's not a long-lasting effect. We say that bankruptcy is the worst thing that you can do. It is a slate wiped clean, but it has a really negative effect. So the key is, again, going back to making sure that you can utilize credit and debt properly before you get to like those dire situations.
Well, I want to thank you for your generosity in giving us all this information. We were talking about how there's like a gap in financial literacy, and I've learned so much, and I hope people at home are also learning a lot from you. I really appreciate your time and expertise. Thank you so much.
Thanks.
Our guests all this week are
Shay Myers, licensed financial advisor and educator of Finance for the Culture. Craig Alexander, president of Alexander Economic Views. Brett House, professor of economics at Columbia Business School and fellow at the Public Policy Forum. And Kaylie Tiessen, economist and policy analyst at Unifor, one of the unions that represents some employees here at TVO.